So in this video, we'll continue looking at some of the other monetary policy tools, and now we'll look at bank rate, cash reserve ratio, statutory liquidity ratio, open market operations, and market stabilization scheme. Now, the first one that we'll look at is bank rate. How do we define bank rate? That is the question, right? So the rate at which the RBI is ready to buy or rediscount bills of exchange or other commercial papers is known as the bank rate. Okay, so this means bank rate is the rate at which the commercial banks can borrow from the RBI. Another way to say this is the rate at which the RBI is ready to buy or exchange commercial papers with the banks. That means it is the rate at which the RBI is willing to lend to the commercial banks. The bank rate has been aligned to the MSF rate, and therefore changes automatically happen as and when the MSF changes, or whenever the MSF changes, the bank rate also changes. MSF is marginal standing facility. We have already seen this in the previous video. So the bank rate has been aligned with the marginal standing facility rate. As and when the marginal standing facility rate changes, the bank rate also changes. Now we know that the marginal standing facility rate is actually linked to the repo rate, because marginal standing facility rate is a penal rate of interest that is based on the repo rate, right? So if the repo rate changes, MSF changes. If the MSF changes, bank rate changes. So this is how it works. Now, the second term that we'll look at in this video is cash reserve ratio. What does cash reserve ratio mean? We'll just define the cash reserve ratio first, and then we'll break it up into parts, and then we'll understand it. Now, cash reserve ratio. The average daily balance that a bank is required to maintain with the RBI as a share of such percent of its net demand and time liabilities that the RBI may notify from time to time in the Gazette of India. Okay, this is the definition. That is the average daily balance that a bank is required to maintain with the RBI as a share of its percentage of NDTL, that is net demand and time liabilities. From time to time, the RBI may choose to change the cash reserve ratio, but the RBI does not do it arbitrarily, or it does not do it very often. Cash reserve ratios are generally set at somewhere around 4%, and they let it be. Okay, so this is notified in the Gazette of India. So let's break down the definition a little bit more, right? So the average daily balance that a commercial bank is required to maintain with the RBI. So a certain portion of the net demand and time liabilities of the bank. What does net demand and time liabilities mean? For example, I am a depositor in SBI, right? I am a depositor in SBI. Now I go and deposit 1 lakh rupees in SBI. That means the bank is liable to pay me 1 lakh rupees. So it is a liability on the bank. Okay. So all these deposits put together, demand deposits, time deposits that has been given by the public, all these put together forms net demand and time liabilities of a bank. Okay. Now let's say 1 lakh rupees, like me, 100 people have given money to SBI, that is deposited money with SBI. So 1 lakh into 100 is 1 crore. So 1 crore rupees has been deposited with SBI. Now the net demand and time liabilities of SBI is going to be 1 crore. Now let's say the RBI says that cash reserve ratio is 4%. That means 4% of this total deposit, that is 1 crore. 4% of this 1 crore has to be kept with the RBI itself as cash, that is average daily balance it has to maintain with the RBI. So that is what cash reserve ratio means. Cash reserve ratio means the average daily balance that a bank is required to maintain with the RBI as a share of its net demand and time liabilities. I hope this is clear. So it is a portion of cash that the bank maintains with the RBI. Okay, let's move on to the next definition. The next definition is also similar, so don't get confused. Okay, now we are going to talk about statutory liquidity ratio. Huh? Statutory liquidity ratio is the share of net demand and time liabilities that a bank is required to maintain in safe and liquid assets such as unencumbered government securities, cash, and gold. Okay. Now I'll repeat the definition. Statutory liquidity ratio is that share of net demand and time liabilities that a bank is required to maintain in safe and liquid assets such as unencumbered government securities, cash, gold. Now, let's say again, we'll just continue from the previous example. 100 people have deposited 1 lakh rupees in SBI and the total is 1 crore. Let's say 1 crore is the net demand and time liabilities of the bank. Now, 4% has gone in CRR, that is cash reserve ratio. Okay. Now, what the RBI also says is that if you have 1 crore, you cannot lend all of the 1 crore that you have to some customer. Okay, that is not safe. Now what happens, let's say 1 crore has been lent by SBI to somebody, some big industrialist who does not repay, then the bank will collapse. That is not allowed, right? So that will not be allowed to happen by the RBI. So there are some safeguards that the RBI has put in place. SRR and CLR are two such safeguards. So 4% is maintained in CRR by the banks in RBI. Apart from that, the RBI says that you have to maintain, let's say, 20% of your assets, 20% of your liabilities, that is whatever you have, in unencumbered government securities, cash, gold, and such liquid assets. What does liquid assets means? Immediately you can change it for some other good. That is what liquid assets mean. Example is government bond, government securities, cash, that is currency, gold. All of these are highly liquid assets. Okay. So the percentage of net demand and time liabilities that a bank is supposed to maintain in highly liquid assets such as government securities, cash, and gold is known as the statutory liquidity ratio. Okay, you can understand that CRR is maintained with the RBI. SLR is maintained in the form of liquid assets. Now, changes in SLR often influence the ability and the availability of resources in the banking system for lending to the private sector. Now, let's say SLR is 20%. Now, if the bank suddenly, RBI suddenly increases SLR to 30%, that means the commercial banks have 10% lesser money to lend to the private sector. So, any changes in statutory liquidity ratio will affect the money supply in the economy. So, SLR is a very useful tool in controlling monetary supply also. This is in addition to SLR acting as a safety valve. Okay, because it is a safety measure. If a bank has 1 crore rupees, it should not lend off all 1 crore rupees to some other people. If it does that, then there can be a run on the bank. That means the bank may fail. Instead of that, what the RBI is trying to generally do is to keep aside 25% of approximately, right? Not exact figures, but approximately 25% of all the deposits of customers in CRR and SLR, so that at least that much money is safe and it can be used for operations of the bank and in case of any emergency. Okay. Okay. This is about CRR and SLR. Both may seem similar, but they are not, and their even percentage also varies a lot. You can just Google, see what is the current CRR, current SLR of the RBI. Okay, right. Now we will look at open market operations. We have already seen what open market operations mean, but we'll just summarize this. So, open market operations include both outright purchase and sale of government securities for injection and absorption of durable liquidity. Okay, so open market operations means it includes sale and purchase of government securities. It can be for injection or absorption of durable liquidity. Now, if a government purchases government security from the market, then what happens? I'm sorry, the RBI actually purchases. The RBI purchases government security from the market. That means it is giving money to the market. That means the total money in the market is increasing, and vice versa. So, the last one is the market stabilization scheme. Market stabilization scheme is an instrument for monetary management, and this was introduced in 2004. Surplus liquidity of a more enduring nature arising from large capital inflows is absorbed through the sale of short dated government securities and treasury bills. The cash so mobilized is held in a separate government account with the Reserve Bank. So, what does this mean? Okay, this was a measure that was brought in 2004. Now, let's say suddenly there is a lot of cash that is flowing into India because India is a developing nation that has very good economic prospects. Our growth rate is almost 7% today, which no other country in the world has, right? And we are already the third largest economy in terms of triple P, that is purchasing power parity. So let's say a lot of inflow of capital has happened into India. Okay. Now, because of a lot of capital inflow, inflation can become high because monetary supply in the economy becomes higher, right? Somehow we have to absorb this capital and make sure that inflation does not become more. So in this case, what does the government do? The government says that, okay, I am going to sell some securities to the market. So these are short dated government securities and treasury bills. When the RBI sells these short dated government securities and treasury bills, money is taken from the market to the RBI. That means the total money available in the market is going to decrease. Okay. So when the RBI sells government securities and treasury bills, money is taken from the market. That means the total money supply in the market becomes lesser, right? So when there is a capital inflow of a more enduring nature, then the RBI has the option to sell government securities to the market and suck the excess liquidity out of the system. Why should excess liquidity be sucked out of the system? This is to ensure that inflation does not skyrocket. Okay. Now, once the RBI sells these government securities, then it gets the money. That money is parked in a separate government account with the Reserve Bank itself. Okay, this is market stabilization scheme. So if there is a large capital inflow into the country, and if the RBI feels that there is a lot of capital inflow or there is a lot of money that is if the monetary supply base has increased, then the RBI may choose to suck the liquidity out of the system. In such a case, what it will do is it will sell government securities and treasury bills to the market, and it will suck the liquidity out of the system, and it will park this money in a separate account in the Reserve Bank itself. So this is known as market stabilization scheme. Okay, thank you.